We analysed the about 13 of the top insurance and reinsurance companies, and over the last 5 years, and sort of pulled out from reports and stuff around what were their main priorities as a business. And very much we've seen a shift over the last 5 years. Previously, claims transformation and other areas, operations as well, have been very much at the top priority list. But actually, more recently, over the last 5 years, pricing has sort of come more to the forefront. So, what's been really happening over the market in the last sort of 10 years, and what's changing now that the pricing is really coming to the forefront?
Yeah, and first to just say that totally resonates to me as well in terms of both my previous experience of being a pricing actuary in industry and the change over the last 10 years. But to answer your question, I mean, a lot of the kind of pain points and reasons why you might want to change have been true for all of those 10 years. That your models, a lot of the pricing models are sitting in Excel, which has a lot of great features, but also brings a lot of challenges if you're trying to be have a systematic pricing process. There's not enough data capture. You are asking your underwriters and your actuaries to do a lot of manual, not particularly value-added work. It often leads to a lack of underwriter buy-in. You're not doing that steering side of things, and you're not capturing the data to then be able to build better models in the future. And you can end up in this sort of sad state of you spend, a company invests a lot of money in pricing actuaries and pricing tools and the underwriters' time on it, but actually the underwriters don't buy into it. The pricing tools are filled in after the risk's written with not much care. Whatever data is captured isn't of high quality because no one's putting much effort into it. And you kind of see where's the value being added. So there's definitely been a need to change. Sorry, I'm not saying that's what every company at all. I think that's kind of a worst case catastrophizing. But, there's been these drivers of change for a long time. So to come to your question of, I guess, why now and why over the last few years, and there are a few, this is personal opinion, but there are a few things that I see driving it. One is kind of the market cycle in terms of, a lot of companies lost a lot of money in the specialty market over the last few years, and I think have recognized that a lack of pricing framework, like a lack of underwriting steering, has hampered them, and is one of the things that they're now trying to invest in while the market's hard, while they've got kind of a good combined ratio, so that they're in a much stronger position once the market does start to soften. And I think that's definitely, EY does quite a lot of sort of analysis on specialty results, and from that tries to kind of tease out drivers of performance. And the two that always seem to come out is, one is just simply good underwriting at a line of business level, and the second is strong management of the cycle in terms of, not growing aggressively when the market's soft and then growing aggressively when it's hard, rather than remediating. And all of those things just talk to pricing. You need to do strong individual underwriting. You need to have good tools and diagnostics and support to the underwriter. To manage your cycle, you need a strong underwriting framework. And so that's one key driver for me.